and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, May 19th, and I'm recording this from my office in Purchase, New York. We have seen a surge in risk assets lately and a stunning recovery from policy uncertainty, bringing stock indices and credit spreads back to where they were at the start of the year. These moves, spurred by trade dynamics like the surprise de-escalation with China, have meant that risk premiums are now narrower and valuations are even richer than when the year began. While we have noted our skepticism about this repositioning, it is perhaps more concerning that other key asset classes are not confirming the euphoria. Specifically, U.S. Treasuries, the U.S. dollar, and gold all appear to suggest a more complex macroeconomic backdrop that equity and credit investors may be shrugging off. Consider first U.S. Treasuries. While two-year yields have moved higher to reflect reduced recession odds since early April, they're still lower than at the beginning of the year, reflecting fundamentally tougher economic growth ahead. At the same time, the benchmark 10-year yield has remained around the 4.5% threshold, which has been a headwind for stock multiples. Importantly, the long-duration yield has been driven mainly by gains in real rates and the term premium. Taken together, this yield curve steepening, higher real rates, and the expanding term premium suggest to us that Treasury investors are no longer just thinking about growth, inflation, and Fed policy, but are keenly focused on America's debts and deficits. At about $36 trillion, U.S. debt is likely to cost $1.3 trillion in interest expenses this year, about 18% of total federal government spending. Overall, the outlook for U.S. debt sustainability remains fraught, especially with ongoing debate around the budget, debt ceiling, and tax bills contemplating additional debt. This likely means higher rates for longer and lower equity valuation multiples. A second disconnect is the direction of the U.S. dollar. Historically, for much of the past 80 years, the dollar has moved in line with real rates. But starting in 2019, it grew strongly correlated with the American exceptionalism theme and the appreciation of U.S. tax stocks. That said, since peaking in January, the U.S. dollar is now down roughly 8% against other major currencies, apparently a victim of flows and global reserve rebalancing. If the dollar is entering a new secular regime of relative weakness as we anticipate, it too could be signaling lower equity multiples. Finally, there's gold. Historically, secular equity bull markets have been defined by the outperformance of the equity index versus gold. However, as we've noted, gold has outpaced U.S. equities since 2022, as it did in much of the 1970s, a tough sideways market for stock investors. The strength in gold, disconnected from its role as a safe haven, indicates likely shifts in central bank foreign reserve diversification. This is yet another reminder that risk premiums in other asset classes may not be providing much shelter from potential storms. Ultimately, we believe we're not out of the woods, and investors wishing for a return of the Goldilocks scenario of 2023 and 2024 might be disappointed. Investors should consider rebalancing and positioning for 5 to 10% average U.S. equity returns in an environment likely to see greater structural volatility, higher real rates, and a weaker U.S. dollar. As such, add diversifying positions in international stocks, commodities, energy infrastructure, and hedge funds. Staying overweight to neutral duration investment grade and municipal bonds still makes sense. As always, thanks for listening. And for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.